student club on campus, and it stands for Business Association of Stanford Entrepreneurial Students. So today, this session is in our Stanford AI and investment series, and we are here to answer one important question. How is AI transforming capital markets? And we have great guests. I'm going to introduce them all to you. So the first guest would be Salil, Deshpande, which is a partner at Uncorrelated Ventures, a legendary solo GP investor. And the second one is Saam Motamedi from Greylock, which is the VC that backed Airbnb, LinkedIn, and Figma. And full disclosure, I may have personally benefited from that Figma IPO. So great venture. And we have Ballard, which is the partner at Cancer Focus Fund and a data-driven private market investments. And finally, we have Whaley, which is a partner at Inception Studios and also a Stanford CS lecturer. And just a side note, we have ordered pizza for everyone, and it'll be served downstairs near the end of the event. And so stick around. And with that, please join me in welcoming the moderator, Mohammad Rasouli, the Stanford AI researcher and the CEO of AIX2.
Perfect. So thanks everyone for joining. I'm Mohammad Rasouli. I'm a Stanford researcher and CEO and founder of AIX2. I did my PhD on AI for investment markets, and that's what AIX2 does. AIX2 is the backbone of fundraising and investment for private market investors. Our clients already are observing 3 times faster fundraising and better return on their investments. The purpose of this event, this series, the Stanford AI Investment Series, is to bring the conversation of how AI is changing the capital markets as a tool for investment and as something that is underlying investment assets. And through that, we have been able to bring speakers from different asset classes. We have had people like David Hefter from BlackRock representing their work. We have had Sopan from Plug and Play representing their work, and we have had a diverse view on this topic. Vinod Khosla presenting how VCs are, and we are very proud today to have a very unique panel for addressing this topic. We have a very unique panel because investment and private market investment is very tailored, very unique in the way that different people approach it, and there is different approaches for innovation in this space. And we have 4 of the very interesting thesis and work that is done in this space today in this panel. So we're going to start, before we start on the logistic, so as said, after it's going to be social hour, please stick around. We have our panelists, we have other VC people here. We have Per VC, Arash is among us, Plug and Play, Sopan is among us, Ravi, one of the founders of Cambridge Associates is here. So for our students, feel free to use the time and interact with the audience here. So starting with that, so we have 4 esteemed speakers here. I'm proud to have them here. I'm gonna ask, starting with this question, and we're gonna go on rotation. Tell us about yourself, who you are, what's your story, what you do, and then tell us about your organization. What's your organization and what makes it stand out? And I'd like to start from you, Saam.
Awesome. Well, one, thanks for having me, and great to see some familiar faces in the audience and a lot of new ones. So by way of quick introduction, I'm Saam. Let's see, my connection to Stanford dates back to when I started here as an undergrad in 2011 and was very fortunate to get exposed to the technology ecosystem here. Got my first job in technology working at a company called RelateIQ. It's funny, all these ideas come back around. 2013, when I started RelateIQ, we were an early AI native CRM, where AI meant doing regexes on top of email to sort of determine email sentiment. That company went on to become acquired by Salesforce, became the fabric of a lot of their AI efforts. And shortly thereafter, I joined Greylock. So I've been at Greylock for about a decade now, leading a bunch of our enterprise-facing work. Greylock, many people don't realize this, Greylock is, I think, the oldest venture firm in the US to have started with multiple limited partners. We turned 60 years old this year, and the firm started on the East Coast, has been based on the West Coast for the last 15 years. And we specialize in very early stage investing in enterprise and consumer-oriented companies. And so many of the investments we've done before companies even exist or are named, there's been no lines of code written, including companies like Palo Alto Networks, which is the largest public cybersecurity company today, $150 billion company, started with 1 engineer in office. Workday started our offices. More recently, companies like, I think someone mentioned Figma, but we backed Figma when there were 7 employees. And then in this AI wave, we've been doing a lot up and down the stack. So the foundation model layer, we're shareholders in OpenAI and Anthropic, and several smaller model companies. A lot of focus on enabling infrastructure in the open source ecosystem, model serving, model observability, and then a lot of focus on applications. Yeah, chat more about all that today.
So, big question, Sam. You were an undergrad CS here.
Yes.
How did you end up being a VC man?
Yeah, accidentally, and I think it's like a very, I didn't seek to become venture capitalist. It's much more fun to be building companies, but I left Whaley IQ. I started a company with a few engineers who I worked with, backed by another venture firm, and that company failed. I came to pitch Greylock a new idea, and one of my now partners said, "You know nothing about how to pick a good idea to work on. Like, don't waste your life working on mediocre ideas. So come join us and help us for a year, and then come up with a good idea to go work on it." So I joined Greylock without the kind of becoming a venture capitalist, and then I failed in leaving.
So for context, Sam has been one of the fastest growing partners in Greylock. Number one, he's being humble. And second, Greylock is a very lean and agile team. Considering 60 years old of history and a lot of good investment, you could easily grow larger AUM and asset under management. What stops Greylock take that path? Why are you emphasizing on being small? Considering that VCs are becoming more and more concentrated and being the law of large number in investments.
Yeah, so I mean, it comes back to like our mission, right? And one of the things that's unique about us is we exclusively invest capital on behalf of universities, including Stanford, who's a large investor in Greylock, and several very select nonprofits. But we have no sovereigns, no for-profits, no mutual funds. And so, like, and the whole way our economic structure is set up is around performance. So we are oriented on driving exceptional performance for our investors, and we do that by driving exceptional service to the entrepreneurs that we back. And so I think we manage billion-dollar vehicles. We're in our 17th vehicle. It's a billion-dollar vehicle. So it's not small, but it's certainly not large by today's sort of standards. And I think our view is like every fund cycle, we want to back 25 to 30 companies and have very, very deep relationships with those companies. And it's hard to overstate the amount of work we do at a per company level, and we just don't think that work scales.
I see. That's below the average for average investment per fund that VCs do, I think, like for something like that. So it shows your thesis for choosing the right one and really working with them rather than spreading and then praying for growth. That's very unique for Greylock. You have some Anthropic investment. Tell us about that.
Yeah.
Sorry to interrupt. People, if you want to walk in to Ballard, we have more space down here, and I'm sure more people are going to show up. So if you want to just
a lot has been written about Anthropic. I think obviously we are in the AI super cycle. It is very clear that very, very large economic opportunities being created around AI. I think one of the things that we at Greylock, many in the venture community got wrong about these model companies, including Anthropic, is many people model them as these like model providers and sort of look at these benchmarks and they're like, oh, well, like the open source thing is like just good. It's the closed source model on a benchmark. And I think they miss two things. One is actual real world enterprise use cases want to just pick the best and buy from the best, similar to the reason why hyperscalers have such success with all of their value added. And then the second is these model companies have demonstrated the ability to move up and become full stack product companies. And I think there's a report out like of numbers in the information last week, but Cloud Code, for instance, is approaching $1 billion of ARR, right? And that's just their first, well, they have several first party products, but I think it'd be fair to assume they have a pipeline of new first party products coming with really healthy margin structures that are just really attractive businesses. And so when you look at Anthropic, they are positioned to become a large winner in enterprise AI, both as expressed through being at the frontier on their core models and serving them through their API business. But to us, even more interestingly, is their taste and craft in building these first party products, and the quality and rate at which these products are scaling continues to impress us. And so we're happy to be investors because of that.
Interesting. A lot to say on that, and we will get back to that in the first round of question. John, would like to hear from you. I know you have been undergrads and Stanford, MIT, and PhD, and you're very unique in terms of a technical person in the investment space and your business.
My name is John Whaley. I graduated from here in 2007. In fact, my name is on a plaque on the first floor at Gates after winning the Best Thesis Award here, along with a lot of other people who are far more well known than me. I also am faculty here at Stanford as well. I've taught here since 2012. I teach compilers, CS 243. Now I teach CS 24G, which is about building applications using large language models. And so this is a new class that we introduced just a couple of years ago, and then now I'm going to teach it again this upcoming winter quarter. So my background, so I've been an engineer for a long time. I've actually now going on 45 years of coding. So it's been coding since 5 years old. And I never stopped. I still continue to code. In fact, I wrote code today, or at least have AI to help me write code today. I've started 3 companies myself, all of them in cybersecurity. 2 of them got acquired. One is still running. And like I mentioned, I teach the compilers data class here. The way I came into this was from a very different route, because I do not consider myself a VC necessarily. That's somewhat of a dirty word in my background. This is, I'm very much a founder and a builder. And what happened was that after my second company got acquired in 2021, I was looking for my next thing to do, and I was kind of just spinning my wheels, right? We were coming out of the pandemic. I was, because my company was about 10 years from founding to eventual acquisition. Second company, we sold right after Series B, so about 6 years in. So these take a while, and so I was looking for my next thing to do and not making a ton of progress because life was too comfortable. I had too many distractions, and most importantly, I had no real deadlines. And so, going by, and I saw all this was happening in this AI wave. I had been working in AI since my second company was AI company. This was in 2015. So I've been working in there for a while. I read the first Transformers paper, like played them and everything. Saw GPT-3 come out and say, "This is very interesting. These are some interesting new capabilities that like nobody expected." Knew that it was going to be big, but also had a really high bar for what it was going to start next. And so it ended up just me spinning my wheels and not making a lot of progress, but I knew exactly what I needed to get away somewhere, like remove all the distractions. I needed to be able to focus, and I needed to be surrounded by other really smart, creative people. This is like what I love, the environment here at Stanford, also MIT, my undergrad, where there's a lot of smart people around that are like working on really interesting things, and go and chat with them and stuff to that type of environment. And then most importantly is it needed a deadline, and especially from academia, they're extremely important. No progress gets done until there is a deadline. And in fact, those 72 hours, like write the paper deadline, it's like the magic time when all work actually gets done, right? And so that's I'm starting Inception. This was a retreat event that we did. This was back in 2022, which now ancient times, is pre-ChatGPT times. The topic area was about large language models and generative AI, and we got about 18 people to show up there who were just in a similar situation like I was. And the amazing thing was 5 companies actually formed from that one event. Went on to raise $10 million from Andreessen and some other really great companies that it came out of that. And it was like, wow, this is really interesting, because there wasn't anything for people like me. I'm not going to go join Y Combinator and give up 7% of my company for that. And the EIR or something somewhere was like, I heard that pressure, and I just a little bit of help to be co-founders. I needed a little bit of a catalyst to help get started. And so that was the genesis of that. So we run these 3-day retreat events. They are 72 hours long. The formula is always the same. We basically bring the best people we can possibly find all together for a weekend retreat. And the last day we have a big demo day where we'll pitch in front of a room full of VCs.
So 2 unique questions I want to ask you. Before that, I want to make sure that we have room for more people coming. Would you mind walking down? There's more space here and more space here. Just feel free to come in. So there are 2 things, John, that I would like to ask you. One is, you have a very unique background as an investor. Number 1, you are a founder who turned into an investor. And I know your former startup was backed by Vinod. Vinod is one of those, he thinks that the path to become a VC man is through entrepreneurship. That's actually a very strong thesis. And think about it, because I happen to talk to different asset classes like private equity and others, and VC is the most complicated asset class. Understanding venture capital is most complicated because we don't know what is a good asset in the VC space. If you read this article about Paul Graham, the founder of Y Combinator, he has seen 30,000 startups. He has a recent article that he argues that the fundamental problem with investment in VC is that we don't know what is a good startup. We don't know what is the founder mode. You think about it. If you're in the private equity or later stage, there are so many LBO models, so many finance models, so many props that work on that, and we have a good understanding. For VC, we don't. Hence, such a complicated asset class, being an investor in that is very tricky. And people like Vinod argue that the path to that is being an entrepreneur, which you have. That's number 1. Second, you did a PhD. I did a PhD, right? So PhDs are trained for certain things, and to avoid from other things. You are trying to be like quiet, working on one problem, deep hard, and how do you see these two backgrounds helping you during this role?
Yeah, I mean, I think if you're in the early stage, it's really, really important. At the beginning, it's all about the founders. And so I think that people who have been founders in the past and have gone through an experience, not only are going to understand and be able to vet people better, but they're going to actually more from entrepreneurs, right? And so I think that there's reasons there. I mean, later stage is a different game. In that one, you actually have a track record. You actually have, data that you can follow, and those ones, I think that you find you can people who are from a finance background. In the early stage, it's really all about the founders and the founding team. Mm-hmm. And so that one, that's it helps in both directions, right? In terms of being able to attract the best quality people as well as be able to understand and vet. And we see this all the time. There's on paper would seem great. It's wow, you have amazing track record. You have your last two companies got acquired. You start a company. But then you meet them, and as an entrepreneur, it's actually you don't really have that fire and that hunger anymore. It's you're trying to build something, but it's more like a lifestyle business rather than a venture scale business, right? And so it's common. Even people have really impressive resumes, stuff, right? So sometimes you have to kind of go really understand the founding team. On the PhD side, I think, to be honest, my experience with PhD is that. It's really that you are kind of masochistic, you have a high pain, right? And so, when you're in this space, because many things around being a founder or working in the early stage is you get a lot of pain, a lot of rejection. And you have to keep going, right? And you never really give up. And so, although I think that necessary condition, but not a sufficient condition to have that high tolerance for pain. But and so I think that helps on the technical side. To be honest with people, and I tell this to students who are thinking about grad school as well. There is a significant opportunity cost doing it, especially now in AI. And so there's almost an adverse selection effect in the other direction now of people who actually are going for PhDs, or I would say apply to a PhD program, get accepted, and then you may not finish there because there's so many great opportunities now, especially so. And I mean, the reason it was I got my PhD in 2000. I started in 2000. That there weren't many great startup opportunities at that point, and then later, but. That was because my plan was to be a professor, and so I would not actually advise people to get a PhD unless, only get a PhD if you plan to go into academia or you have some other.
My advisor returned after mid-demos. He solved some open problems. He got his PhD in 1979 from MIT. He was telling me, Mohammad, whoever asks for a PhD, the answer is a straight no. Because if you tell them no and still they do it, they may finish it.
Yes, yeah.
And what was thesis for Inception? It's very unique. You are backing experienced founders, those who have had 10 years of experience in corporates and others. You are against probably the Combinator effect. I mean, Gary said that they are biased for junior folks, but probably they are.
Yeah.
And second, you have this community-driven approach for founding. Tell us more about it.
Yeah, I point this right because look, when I also approach investment, very much my aim towards it. It's I see a problem and I want to come up with a solution to the problem. So I saw the problem of experienced founders that didn't really have any great or place to go. I mean, I'm not going to join a hacker house and live there for 3 months. I mean, I have a family, I have kids, and I can't do that, right? I'm not going to join Y Combinator with a bunch of early. Many of them have never even worked in a job before, let alone worked in at starting company before. And so I'm also not going to give up 7% of a company for 125K or 500K, whatever. It's the economics didn't make sense, right? And the timing also didn't make sense. So end up building that product there, and then that was very much for people like me, and who are those entrepreneurs. And then look at investment as well, and then you do an analysis and you look at what is the success rates of serial entrepreneurs or people who have experience, right? And so being 20 to 50% higher for those types, right? And the challenge is how do you get into those deals? That is the challenge. Is not can I identify the good deals, but can I get into them? Because all the best deals they quickly, right? And and 90% of the money that a serial entrepreneur raises is from investors that they already know, that have already had.
I can definitely relate that. Winners here, they have some corporate life. They have some money to, they need your support and they need unique work that you do. Perfect. Thanks for that. And let's move on. We'd like to get the same questions from you. Tell us who you are, what you do. Tell us about your organizations.
Yeah, absolutely. So, Will, I'm the Jade Officer at Prime Unicorn Index, and I'm in charge of the analytics at Cancer Focus Fund. So to be honest, I think I just kind of fell into this. I don't have that story, but I kind of started as an internship years ago, and now it's turned into a full-time role, and then actually operating the index and being hands-on with the Cancer Focus Funds. But the Cancer Focus Fund essentially is an oncology-focused venture fund. And so we're partnered with MD Anderson, which is a cancer center out of Texas, and we target stage companies and try to leverage some of our clinical trial expertise and infrastructure of MD Anderson to help with that process. And then the Prime Unicorn Index is a private market index that tracks the share price performance of venture-backed private companies with $1 billion or more in the US. And so we currently have two indexes. We have the composite index, which tracks 225 companies, so that's kind of our full universe of companies that we're able to track that are worth $1 billion or more. And then our Prime Unicorn 30 index, which is a subset of the top companies out of that composite index, which we are currently using to design financial products. And so can't say too much on the financial product side right now. We're in a non-disclosure period with the SEC, but essentially we've partnered with a large asset manager to provide long and short exposure on the index without holding the underlying companies. And so we will have a publicly traded products hopefully in 2026.
So two things. One is that I know you have been behind the research with Ilya Stravolov here in GSP that led to providing an index for US VC, US unicorn. The idea is that just like S&P 500, that we can have an index for public market, that you all know about it, we can have an index for private market. Obviously, way more challenging. Why? Because in the public market, you can log in and check the index, the stock price every day. In private market, it's not like that. You don't know the share value of like Anthropic or private companies like every day. So it's way more complicated to have a valuation for them. Now, they have pioneered to have an index for the private market. And they have gone to next step to turn it into a means for investment, tracking that, understanding where they should invest, right? Tell us a little bit about that research you did with Ilya. And by the way, Ilya is Stravolov, for those you know, that he has been 20 years studying VC, the professor here. And he's like, you can follow him on LinkedIn, very interesting observation, especially around unicorns and how unicorns, what unicorn, what are, this has been his research, his academic research, and they work together. And tell us about the index and what you do, just a little bit that everyone can understand about it and how you use it for investment.
Yeah, absolutely. So just to kind of start an idea of how we price it. So all of these companies have to file certificates of incorporation with the state they're filed in, typically Delaware, some are Texas, some are Nevada, but typically Delaware. We're able to order these and they give us all the deal terms, they give us share prices for each investment round. And so that's kind of where we get our pricing. And then there's also state filings, so state franchise tax documents, employee plan exemption notices, which give us 409A valuations, and then we're also taking closed secondary transactions that meet a certain criteria. We take all that data and we put it into a proprietary methodology. And so all of this data is publicly available. And so the idea behind that is if you're investing in a financial product, you don't want somebody to say, well, Andropic's worth $104 a share because we said so, right? We're able to point to very verifiable, but they're hard to source. They're hard to go through and kind of keep all together and piece it together. And so we partnered with Ilya Stravolov, as he mentioned, just to kind of, he went to some of our data because tracking all these companies, we ended up with 37,000 sets of certificates of incorporation that cover 20,000 venture-backed companies. And so he was doing a lot of research on, are these companies overvalued? And we saw past the 2021, 2022 period where a lot of these companies were very overvalued, but they refused to raise a down round. So they're priced too high in the index, and we're trying to figure out, okay, how can we accurately capture markdowns for these companies if they're not going to raise a down round? And so that's kind of where our research started with him, kind of data and, comparing that kind of led us to where we are today, where we have a more tradable product that has more volatility to it and it's more timely, capturing some of those companies that may have not raised around for 4 or 5 years.
Amazing, perfect. I want to make sure we still have for people who are standing out. If you want, you can walk in. There's more space there, and the other people can also enter. There's more space on this side of the. Okay. So that's one. I would like to ask the same question from you, Salil. So Salil is a solo GP. For your knowledge, raising capital is extremely hard right now. Raising capital for VCs is doubly hard. Raising capital as a solo partner is triple hard. And Salil is the second largest solo GP, which is running 750 million assets under management, and he doesn't have any employee. For your reference, an average fund at that size, a VC fund, should have probably 5 partners for investment and 10 employees, and he doesn't have any of them. And the interesting part with my interaction with Salil was that whenever I text or email, he was responding like sharp and detail oriented, like everything. He caught in my emails and others that I was surprised. Salil, tell us about who you are, why you do what you tell us about the Uncorrelated.
Well, I'm responsive on communication so that I have fewer meetings. So my name is Salil Deshpande. My firm's name is called Uncorrelated. It's an aspirational name. I've been a VC for 20 years. Before that, I was an engineer for 15 years. I went here for grad school from 1989 to 1991. Got a master's in electrical engineering, and where I live now is 200 yards from campus. So in 35 years, I've gone 200 yards. How many yards per year is that? 6. Nobody raised that. And I invest mostly in infrastructure software. I like to be the second or third investor in rounds. So I try to avoid leading rounds so that I can scale my time. I like for someone like Greylock to be the lead so that they can be on the board, and I can be an observer, so I can get some help in tracking and managing companies. What else would you cover?
Tell us more about like the processes you do. How can you be agile? Tell us about your founders' experience. Where do you get the source of LPs?
Well, I've been doing my own firm for 6 years now, but I was with other firms. I was with Bain Capital before. So one of the reasons I was able to raise for my own fund is that I had a pretty good track record. I don't think I'm a great fundraiser, but the product was pretty good. So I was able to just describe the product and say that I'm going to keep doing what I have been doing. I took 43. Back then it was taught using Scheme. I don't know if you still do that. And I'm looking forward to trading Will's index. It was one of the reasons I was excited about coming on Stanford. And I saw investors at investment committee materials for Anthropic, so I have some views about that. I've been struggling to invest in AI, so the field is moving very fast. To back up, when I said I invest in infrastructure software, I mean software that is application software. So if a normal job, if they're using some software, then that is probably application software, not infrastructure software. Infrastructure software is hidden behind one or more layers of other software. You can look at AI as another kind of infrastructure software. I like to make a layered cake where I put AI in the middle. So foundation models are the things that are AI in the middle. And on top of it are use cases and other applications enabled by AI. And underneath it are things that enable AI. Things like data centers, GPUs, CPUs, electricity, cooling, solar. And I'm comfortable in that lower layer because that's kind of what I've done ever since I graduated from here. Not because it's the best area to invest in, it's just the area I understand.
When we had a chat, what seems to, because I was looking how we can handle like all of the operations of it. And you mentioned a few things that stood out. One is to try to be not the majority investor, like maybe secondary, but bring a majority investor that you believe in. So you should make sure that the asset is in good hands in terms of all the operations that needs to be done with the assets. Or if I'm correct, and please elaborate on that, you're less like hands-on with assets, so that allows you to have the position. And the second was honest, the responsibility with the LPs and others, you have these long reports you send to them, and it's so complete and conclusive that you don't need to meet them and other stuff. Is it the way that you have positioned Uncorrelated?
Yeah, so the reason I try to be the second or third largest investor is so that I can scale my time, and so I can do approximately 4 times the number of investments that other investors do. So instead of 30, it's about 100. But the model is that only 1 out of 5 will graduate. So the model is that 4 out of 5 fail. So it's a very roundabout way to getting back down to 30 companies. So because I need to scale my time, I don't want to be the largest investor. I want to be the second largest investor. So when I find something I really like, I take it to people I know at other firms, and now that I know another investor at Greylock, that's another option for me, and see if they will write a check and be on the board. So I'll contact, doing this for 20 years, so I know a lot of people at a lot of firms. So I'll ask 4 or 5 people first. If they all pass, I'll ask 4 or 5 more people. If everybody passes, it makes me reevaluate why I like so much. So it's good feedback for me as well. So even though I don't have partners, I'm constantly getting feedback from partners and others. And then on the LP side, yeah, I write super detailed letters on everything that's happening with the investments. 15-page letters. I had to change from letter size to legal so that I could fit more things in. I had to make the font smaller. And I do that just so that I don't have to do one-on-one meetings with LPs to explain what's going on with the portfolio. So that they have all the information.
Amazing. Perfect. So let's go to the second round of questions. I would like to ask each of our panel 2 questions. How do you think AI is changing the investment? There are many conversations in the area, like especially the VC class. Less funding is required for the startups because they can get ready faster. Probably they have a faster path to IPO or graduation. Maybe the IPO itself is not the idea anymore. So walk us through what you think about how AI is changing the investment, and tell us about your thesis about AI right now, and maybe a couple of samples you can share about your investment. And second, tell us how you think AI as a tool can help you with your job. What have you done? What are your experiences? And what do you look forward to for AI to do for your job? So with these 2 questions, let's start from.
Okay, so on the question, I take issue with, I don't agree that companies require less capital in this environment. It's interesting because everybody says that, but when we look at the companies in our portfolio, they're raising more capital at higher velocity than we've ever seen. And so we've heard a lot on why is that the case. And there's exceptions, and there's lots of examples of things that have gotten to meaningful scale without that. But I'd say by and large, when we look at our portfolio and we track other kind of preeminent venture fund portfolios, the capital raising velocity actually exceeds that we saw in peak 2021. I think there are different observations or analyses around what this is. My take is I think many need now are up for grabs, and those are both categories that are large existing horizontal customer support, reinvention of the software development lifecycle, also new categories like a lot of what's happening in vertical AI. And AI is very different than, let's say, the cloud transition, which played out over many years. With AI, every company CEO sort of pushing their technology team to adopt AI today. I'm talking to the CISO of a 5 bank who told me next year, in 2026, they plan to have 400 agents in production. That same organization probably took 11 years from the advent of cloud to have their first cloud workload in production. And so you've pulled forward a lot of purchasing and customer accounts that are available in the very short term. So if I'm a founder and I'm building an AI customer support, or I'm building an AI code or AI cybersecurity, there's a sense of urgency around the market is up for grabs right now. And if I don't move really fast to saturate the customer accounts, somebody else will. And so, we have exceptions, but in broad strokes, we actually see people raising a lot of capital. And I also think this whole meme, software development is expensive now. I also have not seen that play out in practice. I think the bar, the capital dynamics, just in terms of our thesis, I think for us it's very, very simple, which is one, we're not zero sum in the way we think. We think a massive wave, and that's going to express value in lots of different form factors. And so for instance, we believe in the closed model companies. We also believe in open source, right? We're investors in a company called Base 10, which is one of the leading inference providers used by Abridge and a bunch of the other Cursor, a lot of the large AI application companies to host their open source models. We have Brain Trust, which is observability and eval tooling, around models. We're investing the whole infrastructure ecosystem around open source AI. And then I'd say the big focus for us is in the application layer. And I think our view is if you look at software, terminally where value accrues is to people who own the user. Typically, that's the player in the value chain that is most able to commoditize the others. And so you can own the user by being a foundation model and having ChatGPT or Claude Code, but you can also own the user by being a pure play application company. So for example, I'm on the board of a company called Cresta. It came out of Stanford. Sebastian threw in the the students. Despite not having as much hype as some of the others, they're the largest, to the best of my knowledge, largest pure play AI for customer support company in terms of revenue scale, serving companies like United, Verizon, et cetera, very large deployments, automating customer interactions. Or a company that we help some offices run on the board called Abnormal Security, late stage private, approach in ARR, and the company's building social engineering defense on top of email and sort of other channels. Another really good application of large models. So I'd say there's just lots of applications, and I would say at Greylock, we don't feel it's such a robust opportunity set in a very, very long time. And I was actually talking to one of our former partners, Emil Boucherie, who's also the co-founder of Workday. Workday got started in 2005, same year that Palo Alto Networks got started, both at Greylock's office. And his comment to me was, it's not since 2005 that he feels there's been such a robust set of opportunities for entrepreneurs to go after either disrupting existing markets or creating new markets. And then lastly, to comment on your last question, which is around our investment process and how we use AI there. It's been pretty transformational to us. We're not as correlated. I'm very curious to hear about how you use AI, but we're also on the smaller side. We have sort of 5 partners. We manage these billion-dollar funds, and so we ask ourselves the questions of like, how do we scale and stay competitive when we don't want to scale our team, because we don't want to achieve scale through scaling our team. And so we've gone and decomposed our entire investment process and have rethought each piece with AI. And I'll just give you a couple of quick examples. One is in founder discovery. We have engineers on our team who have built a lot of data infrastructure to go collect data from GitHub, LinkedIn, Twitter, other revenue signals, and try to populate for us the companies that are inflecting and the people who are inflecting. Because 90% of the investments we do is the first capital in the company. How do we discover a really smart young engineer who's rising at Stripe and Finder before any other venture capital firm does? So we have a whole effort on the sourcing side. And then on the supporting side, after we back an entrepreneur, we use AI to help recruit and discover customers who are really qualified prospects. And we've seen that be a huge enhancement to the way we can support companies. We backed a company called Resolve AI, which is building an AI software reliability engineer. I think in the last 12 months, we've sourced and placed 19 engineers at that company, and we don't have a large recruiting team. So it's part of the ways we're operationalizing AI internally to actually successes.
So question on both topics you mentioned. First, with this AI solutions, you said AI as finding prospects, sales and marketing is definitely one of the growing applications of AI. There's so many companies out there. It's just like coding, which is growing so fast, it's growing. But on the finding a good founder, there's a lot of academic research in that. I counted once, and there's probably 200 papers which are finding good founders with AI. But data is not there. How do you do that? What signals do you look for, and what is the accuracy? In other words, what do you look in a founder if you want to invest in them, and do you find them with those AI solutions?
Yeah. So again, if I go back to the framing of over a 3.5 year investment period, we're going to back 30 founding teams. So think of it as 10 to 12 teams a year. We don't need to back every company. So for us, it's a question of we find exceptional people and be a part of their journeys. We have found that is helpful for us. There are different archetypes. The archetype for us, we find there are 3 archetypes that are most compelling. One is people coming out of either a university or a large company who have worked on some open source project that's related to a company they're going to build. And so we have a lot of tracking around and once an open source project is really taking off, everybody's aware of it. So for instance, how do you know who are the really high quality contributors in the world, and what are the projects they're spending time around? What are the ones they're chatting about in Discord channels and the rest? That's one archetype. This is what we call rising stars. So who are like the top product, in particular engineering people, at relevant companies. So if you take Databricks, Anduril, OpenAI, Anthropic, who are the stars inside those organizations? There are ways you can look at career progression. We also do just on the ground triangulation and feed that back into our data lake around hey, Bob, like who are top peers? And then we go triangulate a bunch of that information. And then the third,
because of the tools, like how do you build an entire company, like not only a demo, but entire pitch deck, business plan, everything within 72 hours, like that would have not been possible in the past, but now it sort of is because you have that are fully AI native, right? They know and understand these tools, they use them for everything, and they, and yeah, productivity. And I do see there's an emphasis for kind of, especially right, keeping headcount smaller, like emphasize more on like build using AI agents. How can we move? How can we keep moving quickly, right? So it's a fundamental mindset, I think. And if you look at, it's hard to change that. I mean, it's like once your DNA of your company there, and like, but everybody is trying to do it because AI. This is the biggest it's biggest in my lifetime by far. You look at, we mentioned about, this cloud, and that was because you used to have these racks of servers that you would go and have in your office, and you would, or maybe a colo, but you would actually maintain that hardware, and then we kind of displaced that, and now I displace that to these cloud providers, right? But AI, that we're doing this for knowledge work, and the size of the knowledge work market is at least 100 than the compute market. That's the promise. Now, just to be also really clear, we're absolutely in a bubble right now. Like there is much irrational exuberance, and there's a lot of companies that are being funded that honestly should not be funded, should not exist. Yet they do because so much excitement and there's so much coming in. Obviously I've been like the late. This is remind me exactly of 2000, but there is when you have based on background with a little more than a memo and with no data, no product, nothing, and they're raising money, billions of dollars, at valuations, or some of these, there's no, and like they're not even planning to make a fundamental business, and yet they're still getting funded. Some things did not in this whole AI wave. This is like things like who is the customer, and what is the problem that you're solving for them, and are they willing to actually pay you for this, right? How do you reach those customers, etc. Like all those things that were true before AI, they're going to be true after AI as well, right? And so because of there's this large amount of around AI right now, there's a lot of companies that are not, they're either building a feature in somebody else's product, or they're not, because they're not solving some burning need, right? And yet they're still getting funded, and this is actually bad for the whole industry. I'm looking forward to the bubble quote, or things going back to what happens is that all these talented people who should be working on something else, like their company is not going to be successful. They're not going to go, and yet they're obligated because they're kind of keep going, right? It's almost better for those companies to kind of die off and that talent to go work at companies that are more promising. So
that's true things. In the Bay Area in the last 2-3 years, we saw waves of this collective movement in directions that was, as a technology person, you see immediately it's wrong, and then millions of very tailor-made certain areas, or other things that you couldn't see that they are going to survive with growth of GPT, but we had this, collective movements.
Yeah, and I think this is part of the drive to go earlier and earlier. You see more and more funds starting to go earlier and earlier, because that's where the kind of the valuations start to make the things can go up pretty after that. This is, and then on part of your question around kind of use of C. I come at a very different standpoint as an engineer. I came into the looking at and I'm like, oh my gosh, like this whole industry is completely disrupted by AI. And because so much, what even in the day-to-day life, not to mention anything else, there are so many out there for utilizing AI, and I think many VC firms, they understand this. Like many times they actually have engineers, or they have data scientists, or they are kind of approaching it like that. But I guess if you don't approach it from an engineering mindset, I don't think you're going to likely be successful. Like there is this VC window, which is kind of like the old boys club, I know some people at Stanford, and I have this network, and then therefore I can get access to these deals, I can make these investments, right? I think the days are numbered for these for those firms. This also moves really slowly because capital is very, LPs are quite about, well, let's look at your track record. You're gonna have 20 years of track record, then, I'm not, I want to put, and this is why they kind of lead to these mega funds that are like many, like a lot of capital is going into those. Because they have I think many, like the ones that are not embracing AI are going to be disrupted. I remember Mark Andreessen was saying, he's like, oh, well, I think all these other industries are going to be disrupted. Oh, except us, except for AI, except for VC. And I was like, oh, you don't, you don't know. It absolutely will be disrupted. But I do think that the human element is still there. It's not, I don't think that the future is going to be a fully, a AI VC that's all the decisions and everything. Because, it's like VC firms are using AI to better focus their time on the opportunities that are going to be more, that are in terms of sourcing better founders. But it still comes down to that personal relationship. And so AI is an enabler to be able to those to scale. I think that's the direction.
I totally agree with you. Like our is mostly with private equity and later stage investors, and they ask this question. I think the core element of human interaction and the trust for transacting money is going to stay for investment across the asset classes. But a lot of that, the same idea that is now for entrepreneurs, you mentioned, like $1 billion company that Saam can put out there, as a totally paradigm shift for entrepreneurs, like our cohort of entrepreneurs. Same is, I see that happens for investors, like they want to be AI native, one partner, $10 billion asset under management or whatever. We will see how far it goes. I want to hear the same from you, Will. Like how you seeing your space of investment, secondaries, private market, which is slightly different from VC, private unicorn, private prime unicorn index, as well as the cancer focused fund, both of them. How is that changing with AI? And tell us about what AI tools you use and how was the impact for both of these funds that you're involved in?
Yeah, absolutely. So we're not primary investments into AI companies currently. So while I don't have much insight there, I do have a lot of insight from tracking these companies through the index. And so, just looking back 2 years ago, we had 2 companies in the top 10 that were AI related. The top 30 index had a total market value of $350 billion, and we had 1 company with a valuation of $100 billion or more, and that was SpaceX. Today we have 4 companies worth $100 billion or more. Besides SpaceX, they're all AI companies. 7 out of 10 companies in the top 10 are AI, and the top 30 index has a market value of 1.1 trillion. So it's about triple. And so I think it was mentioned earlier, we're seeing companies raise much more rapid pace than they were previously. And what's really interesting is you're seeing these AI companies raise at higher step-ups in between those rounds than non-AI companies. So what that's kind of led to is a lot of concentration that we're seeing. So 86% of the top 30 index, so pretty much the top 30 private companies are made up of those top 10 companies, 7 of which are AI. If you go back 2 years ago again, it was 67% was made up of that top 10. So you're seeing a really strong concentration towards these very, very large companies. And then how we, looking at it 2 different ways, whether it's the cancer focused funds or the index. On the cancer focused funds, we're using it mainly for LP screening. And so how I would kind of describe that is you can imagine it as an AI placement agent. So instead of going out and hiring a placement agent who can introduce you to their Rolodex of 200 limited partners, we're now able to screen as many LPs as we want to against attributes that we design, which can give us a report that says, hey, this limited partner would be a good fit for you because of their interest in cancer, or you're connected with so-and-so on LinkedIn. It can give us even clearer picture on not only are they fit, but how do we go about reaching out to them. And so you go from this placement agent who's charging a pretty hefty fee, controlling all the data, to now we control the data, and we can control the attributes that we want to apply to this screening. And so we're able to get that going in days. So it's saving us a lot of time, it's saving us a lot of money. We can kind of scale down that aspect of the team. And on the index, we're using it to do a lot of research and to automate our index, kind of reducing the need for having analysts. And so how that looks is, like I mentioned earlier, 37,000 sets of certificates of incorporation, and then a lot of other complementary filings. And so a certificate of incorporation is a legal document that's 25, 40 pages long, and we want to extract 13 to 15 sets of deal terms. And so a lot of them are straightforward, like you'll have the Series D price is $20, right? A lot of times it's not there for, let's say liquidation preference. It may not be, and it can take somebody, an hour or two to go through them, counting the amount of time that it takes to train them to read these documents. So we've worked to train AI models specifically pull these deal terms out of these filings, use the data that we're capturing from, and then spitting out, an Excel sheet with all our index data. And that's saving us a lot of time and also cuts out a lot of human error, because previously it is all, I'm going in, I'm reading this filing, I'm taking this price and putting it in an Excel file. And so, while you still kind of need someone checking that, obviously, it really kind of reduces some of it. And that also kind of enables we're using to potential secondary investments based on some of our index data. And so, let's say I wanted to ask like a nuanced question against a lot of these filings that we have. Say not even the 37,000 sets of filings, we have 225 filings for each company in the index. I want to know, okay, which one of these companies has an IPO? That would take a lot of time for me to go through and pull that. I can ask that now and have it answered by the end of the day. And then I can ask follow-up questions. I can say, okay, do this historically for companies with their index 5 year. Did they go public? And if so, did they go public above or below that IPO ratchet? And so, that's a lot of research that is not for a small team like us, where we didn't have the capacity to do that previously. So
I'm going to ask a selfish question from you. What AI tools you use and what has been your experience working with them? But for both of them, the index and the LP screening and fundraising.
Yeah, so for both, we're using AIX2. And so it's actually facilitated from Ilya, who we mentioned earlier. And so, kind of how all this came about is about this research. It's like, hey, I'd love to be able to ask this question to all these filings. How do we do that? And he introduced us and said, I think Mohammad has a pretty interesting way to go about this. And so we started just by trying to automate the index and then kind of went from there. And now we, like I said, building out this LP screening platform.
Definitely. It's been an amazing experience. And just to share a bit about the technical challenge we had when we started that, because I guess Prime Unicorn Index had tried other solution providers and both GPT kind of a solid solution. The challenge is they had terms that the startup signed when you fundraised, and those legal terms, reading them is complex because a little nuance in the sentence just changes the entire meaning, like the languages and others. So we had to crack through that with a lot of evaluation sets and others. At the end, we are very happy that we were able to get to the MVP version of response for them in one, and obviously optimize it from there. And on the fundraising side, I'm very glad that we see, because fundraising fundamentally, each fund, and you have seen on the panel, is so unique, especially in private investment, in thesis and who they are and what they do and how they represent them. That for LPs, finding the correct LP that matches to your thesis is kind of a marriage kind of thing. That's basically what we have been cracked through, and we're very excited to see that you're raising $200 million for a cancer focus. Amazing. I would like to ask you the same question, Salil. Tell us about what you think AI is doing for this investment and general investment space. I know you have a moving to infrastructure, and tell us about what AI can do for you or is already doing for you.
Well, I think we are overvalued in the public markets, in AI, in private markets. So I said in my last LP letter that we're taking the last couple of puffs from this bull market split before we have a small bubble pop. But I think we're in a super cycle, so the super cycle will remain intact. So we'll have a small bubble pop here, and some people will get hurt, and the super cycle will stay intact. I think the LLMs will get commoditized. So I was surprised to hear you say that seeing that, because I feel like I'm seeing that commoditization. In fact, I invested in a company that takes that comprises a workbench that allows them to take open source models like DeepSeek and Llama and trim them to be 1/10 the size and 10x faster. Because for particular enterprise use cases, you don't need the models to know everything about everything. And then on the API front, I like a lot of applications. They have become interchangeable, and there are a lot of products that help you make them interchangeable. I think consumer products like ChatGPT and Claude are actually will commoditize less, develop an attachment to them. But I worry about the APIs. In my own work, I use I don't use a ton of AI. Whisperflow. I have a portfolio company called Sybil, SYBILL, which joins online meetings and besides transcribing and making notes and doing and updating systems of records. It also pays attention to people's body language and expressions to figure out what was important. But I have a particular workflow that I'm looking for a solution for. If someone has a product here or knows of a product or wants to build a product, which is from all the online meetings, and their names in the boxes, so you know who they all are. From my LinkedIn account, you know what companies they work for, which company that is. I have a folder for each portfolio company where all file names have dates in them. It's YYYY-MM-DD. That should be for me to be able to ask, what are the challenges of this company? What are the next major milestones of this company? Because we'll have talked about them, or I'll have gotten a deck or an update, or I have something that answers that question. And I don't even need to be cross-company. I'm fine with just being able to talk about one company, but in the future, maybe cross-company. What are the basket of or for the next fundraise for this company, which other company would be interested? A lot of companies, so I need sort of volume solutions for all of them. I'm not very ambitious, so I think a target I'm currently investing out of a $315 million Fund 3, which is 55% invested. So I've got a while, and I'm investing it slowly. So the 55% was invested over 3.5 years. I've got a while to invest the rest. And the target for this $315 million fund, the fundraising target, was 225. So it got a little bit oversubscribed, which was okay with me. It just gives me more time in between fundraisers. But I would target 225 again after I finished investing in this fund, because I think that's about the right size. In firms, it's $200 to $250 million per partner for investing. So yeah, it's kind of silly to have an AUM target, and I guess you have an AUM target if you have a target for fees. But
Amazing. That's one last question from all of our clients. How can the people in the audience be in touch with you, and what's the best way they can reach out to you?
I'm John at Greylock.com.
John at InceptionStudio.org. You can just look up on LinkedIn. I'm happy to.
Yeah, great, or unicornindex.com.
Yeah, LinkedIn's great. I'm still at Uncorrelated.com.
Cool, and I'm also on LinkedIn. If you're a student who looks for a job at the intersection of AI and finance, we are hiring, or just want to chat about it, then I'll look for it. If you're a VC or another type of fund who wants to fundraise, talk to us. And it's a pleasure. We are going to have a social. Before we go, I would like to ask our panelists to be here. I think it's an amazing opportunity for our students, especially basis is for the students on campus. We do have Arash from PVC here in the audience. We have Sopan from Plug and Play as well. We have Ravi, has a lot of experience with Cambridge Associate. I encourage everyone to enjoy talking to them. All right, perfect. And let's appreciate our speakers. We're going to go move down the stairs. We're not going to have food up here.